Hi, I'm James Robinson, and this is a Robinson Stocks stock pick. This is my third video on the company OFLX. This video is going to talk about the company's balance sheet and particularly the company's debt load. I look at debt load as being a very important component of analyzing a company, and I look at that for several reasons. The first reason is a great company shouldn't need a lot of debt. In fact, a great company should be paying down its debt or have no debt at all. So when a company has a lot of debt, that's a red flag. When a company needs to continue to borrow money to fund their operations, that's also a red flag. But the flip side of that is also true. The company that has a lot of debt has a lot of risk associated with it. When the company's operations go bad, when the economy goes bad, when tariffs hit, when COVID hits, whatever, and the company's unable to generate the same kind of profits they were, the bank still wants their money, the bondholders still want their money, and you still have to continue to pay that debt. And that means that there's no money left for the shareholders. It also means the company could get wiped out. So on the one hand, having no debt means is a pretty good indicator of a great company with long-term strong financials. And a company with a ton of debt represents a ton of risk for things to go really, really bad in the future. And so while most investors don't spend much time looking at this, I think it's actually a third of my analysis when I look at a company. The first place that I start my search when looking at a company's debt is I want to know what its debt is in relation to the cash. So I look at the amount of cash a company has on hand. Obviously, a lot of cash is a great sign, but only up to a point. At some point, a company is hoarding cash that they maybe can't use efficiently as the shareholder can, and so that money should be returned to the shareholders in some way or form. This company's an interesting case along those same lines. You see the company has built up a nice cash reserve between 2012 and 2018. They got to up to about $50 million, which for a $300 million company is an awful lot of cash. And then you see it plummeted in 2019, the amount of cash they had on hand. The reason that plummeted is because that company paid a special dividend, and they paid, I think, $3.50 per share or $30 million to the shareholders. I love that. Other thing to keep in mind here is this company's closing in on $50 million of net worth again, net cash again, and that's a really good sign that that special dividend might be coming again. At these prices, I would prefer the company buy back stock instead of paying dividends. When the company pays dividends, I have to pay taxes on it, as well as the company having to pay taxes on the income. But if the company buys back dividends, I own a larger percentage of a great company at what I think is a good price. So I get a tax-free benefit because I own a larger share of the profits, and likely the stock price will go up commensurate with the amount of shares that are bought back. Another thing that I look at when I look at the company's debt is I look at the relationship of current assets to current liabilities. So first, let me explain what's going on here. Current implies that it's going to happen within the next 12 months. So current assets are either cash or liquid assets that the company has on their books or will have in the next 12 months, reasonably expects to have in the next 12 months. Current liabilities are what the company expects to owe in the next 12 months. And I like to see a significant gap in between those two, implying the company has the cash on hand to fund their operations. You'd be surprised at how many companies you find that don't have that. So this is sort of a minimum requirement for me. And you can see this company has a significant amount of cash and current liabilities relative to their current debt. They have a significant amount of current assets relative to their current liabilities. So another way of discussing the difference between current liabilities and current assets is the current ratio. And the current ratio is just the relationship of those two numbers. And you can see this company's current ratio is about 4. That means they have about $4 of current assets for every dollar of current debt. That's really, really strong. And what I've done here is I put this in relationship to all the companies I've ever looked at. So I've looked at about 1,500 current companies, about 2,000 companies total. And you can see the red line is the top 10% of companies. And you can see this company is in the top 10% of companies for the current ratio, which means they have plenty of cash on hand. What I also like about this chart is you can see again in 2018, the current ratio got very high to the top 10% of companies. The company recognized they had too much cash on hand, that they didn't need it and couldn't use it efficiently, and they returned it to the shareholders. I think we're getting back to that point again. We talked about it being $50 million was the threshold 5 or 6 years ago, and relative to current liabilities, I think we're actually higher in terms of cash on hand than we were then. So again, I think this is an indication this company is likely to start returning additional monies to the shareholders. This chart looks at both kinds of debt that a company can have, which is current liabilities, which is short-term debt, and long-term debt, which is money that is not owed today and won't be owed for the next 12 months, but will eventually be owed to be paid back. And you can see here that the company has had we're looking at several things at this chart. The blue line, we're looking at how the current liabilities have changed over time. And you can see here, they're very, very flat. The other thing we're looking at is debt. Even though the earnings have gone up over time, the company's debt has remained very, very constant. We're under $8 million of debt for a $300 million company. That effectively is no debt. And that's a wonderful sign. We're very, very excited about that. And that tells me this company has very little risk associated with ownership, with owning it. The economy could turn dramatically. People could stop buying corrugated steel cables, and we'd still be okay for quite some period of time while we work through that economy. This chart looks at interest payments, and what a lot of people don't think about is that debt is really only important in so much as it creates an interest payment obligation. It's the interest payments that get people in trouble. Not very often it's the balance of the loan. Often you can refinance the loan if you're able to pay the debt. But if you can't pay the debt and pay the interest, then that's really where the problem lies. So I like to look at how a company's interest payments are changing over time. You can see here they had one significant blip, which I don't even know why it was in 2011. I didn't bother to look, it's too long ago. But they had another significant blip in interest payments in 2020. Everybody can understand that was due to COVID. The company probably took out money either through SBA loans or other forms to create a buffer through what they thought might be a bad period of time, which I think was a very conservative thing to do. But other than that, they don't make any interest payments. That's wonderful. The other great thing about this is the red line in the next chart looks at the company's interest income. I am very happy if the company's interest income outpaces the interest expense. In this case, there's $1.5 million of interest income, no interest expense, and so that's great. Another thing that I look at, which doesn't make any sense on this chart, is interest coverage ratio. And that's the amount of income the company makes relative to the amount of interest they have to pay. And I like to see that number be, a number with some buffer. In this case, the company doesn't pay any interest. And as a result, it doesn't pay any net interest. And as a result, there's nothing to show on this chart. When looking at a company's debt, you want to have some way of looking at it in relation to the facts. So a company might have $5 billion in debt, but it's a very large company and it makes $5 billion a year. That means they could pay off their debt in a year. That company doesn't have very much debt relative to the size of the company and relative to the earning power of the company, even though $5 billion, one would think, is a lot of debt. And so one of the ways that I try and do that to normalize things across a wide range of companies is I look at how many years it would take to pay off the debt. And you can see here that this company is, a matter of months to pay off all of their debt, which is spectacular. Basically means the company has no debt. And for my analysis, it means the company really doesn't have any debt at all. And that's why we look at this in terms of years income to pay off debt. I try and do the same sort of thing when looking at interest expense. I don't really care how much the company has in interest expense, except as it relates to the operating income of the company. Remember, the operating income of the company is the amount of money the company makes after deducting cost of goods sold from revenues. And the amount of money that's left, the operating income, is the money that the company can use to pay off their various expenses related to operating the business. One of those expenses, obviously, is interest. If you have a company with a ton of debt, then that interest expense often weighs on the earnings and makes the company less profitable. And so I look at this in terms of interest expense as a percentage of operating income. I don't want to see more than 15% of a company's operating income gobbled up by interest expense. In this case, obviously, the company this isn't an issue at all. And so this is, again, the balance sheet of this company is exceptionally strong and exceptionally desirable. Another way of quantifying debt is to look at the debt in relation to the equity. If a company has $5 billion worth of debt and $10 billion in cash and $20 billion worth of plants and equipment and $5 billion worth of inventories and on and on and on, all of a sudden that $5 billion of debt isn't very significant. And so the way we look at that is called a debt to equity ratio. And you can see this company's debt to equity ratio, because it has no debt, is virtually zero. And therefore it's in the top 10% of companies and it's exceptionally strong. And again, when I talk about these things, oftentimes when I'm making a video on a company, it's almost always because I think it's an exceptional company. And so a lot of these charts don't matter. But if you looked at this chart for 80% of the companies that I've looked at, it's very, very unattractive relative to this. One day I should do a video on the average company so you can see how much less desirable those charts are than the charts that we have here. So that pretty much does it for the balance sheet of this company. Again, the company has no debt. They have 50 million in cash. The current ratio is, where I want it to be. And both the amount of cash on hand and the current ratio and the company's past imply the company's likely to make a significant return of capital to the shareholders, probably in the form of dividends because they've never bought back shares. But if I had a vote, I would ask them to pay back shares or to buy back shares. But other than that, this company's flawless in terms of its balance sheet, and I can recommend it on that basis without any hesitation whatsoever.